Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Friday, the 22nd of August. I'm Stephen Cowell in London. Coming up today, default warnings begin to pile up for the lucrative private credit market as analysis suggests stress levels are underappreciated. Bond investors await a key speech by the Federal Reserve Chair Jerome Powell as they look for signs policymakers may start cutting rates next month. Plus, why Germans are increasingly ditching the safety blanket of savings accounts for the risk and reward of the stock markets. Let's start with a roundup of our top stories. Warnings on defaults are starting to pile up in the $1.7 trillion private credit market. A number of analysts this month are holding up a light to signs of underlying stress. Analysis by JP Morgan says the rate of companies not making payments in this space is 5.4%. That's double the default rate most see in private credit. Bloomberg's James Woolcock has more.
Money has surged into private credit in recent years, then interest rates shot up. With many businesses unable to pay, private lenders use tools like payment-in-kind loans, where rather than being charged interest, the sum gets added on to your final debt. Analysts call these agreements shadow or selective defaults. They say when you take these private arrangements into account, the rate of defaults in the space doubles to between 5 or 6%. That has spooked many, including regulators who fear it hides stressed firms and could be the prelude to a bubble. In London, James Woolcock, Bloomberg Radio.
The Federal Reserve Chair Jerome Powell will deliver a key policy speech in the coming hours as bond investors look for signs that the central bank plans to cut rates at its next meeting in September. Rates have been on hold since December as policymakers worry about sticky inflation and the possible impact of tariffs. Speaking to Bloomberg, Chicago Fed President Austin Goolsbee says he's hopeful the latest inflation print was a one-off.
The last inflation report that came in where you saw services inflation, which is probably not driven by the tariffs, really start shooting up is a danger. That's a dangerous data point. I'm hoping that that's a bit of a blip. So I think we still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
Goolsbee's comments come as Jerome Powell faces mounting pressure from President Donald Trump and other White House officials to resume cutting rates. Meanwhile, reporting from the Wall Street Journal suggests the Fed chief will also use his speech to scrap the central bank's recent approach to setting rates that focused on risks associated with near zero interest rates and low prices. And you can listen to Jerome Powell's speech live on Bloomberg Radio at 3 p.m. with full analysis and reaction to follow. It's being reported that Nvidia has told its component suppliers to halt production of the company's H20 AI chip. According to the information, which cites unidentified sources, Nvidia issued the orders this week after Beijing urged local firms to stop using the chips. CEO Jensen Huang says the firm is in talks with Beijing.
U.S. government, the Trump administration, has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
Jensen Huang speaking there in Taipei. The H20 is a less powerful version of the company's cutting-edge AI accelerators and was designed to comply with US export controls. However, any suspension of production would raise fresh questions about underlying demand for the product. The United States and the European Union have taken steps to formalise their trade pact. The two issued a joint statement setting out specific benchmarks for the EU to secure tariff discounts on cars, pharmaceuticals and semiconductors. The EU's trade chief, Maroš Šefčovič, says there's more work yet to be done.
This is not the end. It's the beginning. This framework is the first step, one that can grow over time to cover more sectors, improve market access, and strengthen our economic ties even further.
Šefčovič and other EU officials have been criticised for failing to get lower tariffs on wine and spirit exports to the United States. A White House official says lower tariffs on EU goods could be in place within weeks. The British government will buy 6 new air defence systems to deploy near Ukraine. The UK's Ministry of Defence says it is signing a £118 million contract with European arms manufacturer MBDA for the kit. It comes as European and US defence chiefs meet to discuss what security guarantees they can offer Ukraine if a peace deal is reached with Russia. UK consumers are the most optimistic they've been about their household budgets in a year, according to a closely watched survey. Bloomberg's Chris Pitt has more.
The UK has faced something of a heatwave this summer, and it appears that Brits are also warming to the outlook for their personal finances. GfK's index tracking sentiment for the next 12 months rose to 5 in August, up 3 points from July. The recovery in household confidence suggests the Bank of England's efforts to ease borrowing costs are finally filtering through to the real economy. But it's not all clear skies ahead. GfK's Consumer Insights Director Neil Bellarmany warns improvements in sentiment remain fragile, with, quote, clouds on the horizon in the form of inflation and rising unemployment. In London, Chris Pitt, Bloomberg Radio.
Those are your top stories on the markets. We're looking at Euro Stoxx 50 futures down slightly this morning. FTSE 100 futures are up slightly ahead of Jerome Powell's speech later today. The Bloomberg Dollar Spot Index is speaking. The Bloomberg Dollar Spot is up by 0.1%. The 10-year Treasury yield holding steady at 4.33%. Wall Street futures are looking flat or a little lower for Nasdaq futures at the moment. In a moment, we'll bring you more on the default warnings that are beginning to pile up in the private credit market, plus why Germans are increasingly embracing investing in the stock market. But first, another story that I wanted to mention this morning. Are you hearing the word clanker more at the moment? If not, you might be about to. Bloomberg Opinion's Catherine Thorbeck has been writing about the word, which some of you might recognise from Star Wars, and how it's been picked up by younger internet users as a blanket derogatory term for artificial intelligence and robots. It's been used to express frustration with things like AI slop that's turning up everywhere online, or the hallucinations the technology can create. It's now showing up in search trends, and Catherine expects that it may well end up being one of those words of the year when we get the new lists from dictionaries. It's also a good illustration of how the extreme enthusiasm for AI from some isn't that widely held. In business, for example, a McKinsey survey showed that 95% of firms haven't seen returns on their investments in the technology. For consumers, mentioning AI is proving a turn-off for some shoppers, and polls show people are worried about the effects the technology could have. Now, there's no doubt the potential for what AI can do is huge, but Catherine makes a good point that AI needs public trust to succeed. And if teenagers are already making fun of it online, maybe that's a sign that tech companies need to do a little bit more to focus on practical applications rather than just rhetorical ambitions. Maybe it means AI won't take over everything after all, or it'll just end up being the cranks versus the clankers. You'll read the full story at bloomberg.com/opinion. Well, let's bring you more now on our top story on the rising warnings of defaults in the $1.7 trillion private credit market. Our market supporter Valerie Teitel joins me now for more. Valerie, by their nature, it's even in the name, we have less data on private markets than we do on public markets. So how are we tracking this uptick in defaults, and how significant is it?
Look, this is really where it gets murky. The question of how to track defaults is really almost have to be taken on a case-by-case basis, looking through all of these private loans, because sometimes these loans are basically restructured, which in a traditional corporate bond space, that kind of restructuring would be classed as a default, but not necessarily so in the private credit market. These are things like deferring interest payments, or perhaps selective defaults like maturity extensions or any significant amendment activity. So whereas on the surface, the official default rate for private credit stands around 2 to 3%. That's data compiled by JP Morgan. In reality, JP Morgan also warns that could be something much higher, and they actually penciled in 5.4% as the default rate if they included some of these quote unquote selective defaults. And that would put private credit more in line in terms of the default rate with the syndicated loan market. That's something that's done via traditional banks. We also had some data from S&P Global and from Lincoln International that showed that default rates in the second quarter of this year could have been as high as 6%. And that's up from what they calculated as a 2% run rate when everything was going great back in 2021, when this market was originally booming. And really, to complicate this all further, a lot of these borrowers are not really monitored by credit agencies or advisory firms, so it's really hard to get a sense. But it does seem to be like there is some data from a few research analysts out there that are showing that these selective defaults, if you include them into the official rate, it could be much higher.
Okay, a fascinating story that we've been reporting on this morning. But let's turn to the main event of the day for markets, the speech by Jerome Powell at Jackson Hole. What are we expecting? I'm
already sweating about what's going to happen this afternoon. Let me tell you, the market is really wanting to hear something dovish from Jerome Powell. They want him to somehow mention that the labor market has been weakening and signal a September cut. That would definitely spur a bond market rally, spur an equity market rally off the back of that. The risk is, though, for at least for what's priced in, is that he does not change his tune on the labor market. Instead, maybe focuses on some very nuanced monetary policy framework. One thing that our own Anna Wong has been writing about is he could draw attention to dropping the flexible average inflation targeting framework, which would be slightly hawkish. This is something that they used almost to look through inflation back in 2021 when it was first rising. And then on the flip side, he could really say nothing. He could say that they're data dependent. There's still another CPI print and another payroll print before the Fed convenes again in mid-September. But the market is really hoping for something dovish here. We have seen odds for this rate cut in September been pared back quite substantially this week. After pricing in 100% last week, we're now down to 75%. So the market has already been rethinking how they've been pricing in these Fed cuts. We also had a round of data yesterday that was fairly mixed. Jobless claims rose, but then we had really good PMI data out of the U.S. as well. So it seems mixed across many pictures, but I mean, I'm holding my breath for 3 p.m.
Stay with us. More from Bloomberg Daybreak Europe coming up after this. Now, Germans have long preferred the safety of bank accounts to the risk of the stock market, but that tide appears to be turning as the German equities market booms for a third year running. A survey by BlackRock has found that more than 3 million Germans have begun investing in stocks over the past 3 years. That's the biggest increase seen in Europe after Britain. Our senior markets editor, Phil Serafino, joins me now for more. Phil, good morning. What is drawing Germans to the stock market now?
Well, you know, there is the bull market, which you mentioned, and that always attracts traders when they see prices going up. But that's bull markets come and go, and there's a longer term trend at work here too, which is Germany, like a lot of countries, is facing an issue of they have an aging workforce. They have this pay-as-you-go pension system, and Germans are realizing the pension that they're counting on may not be there when they retire. There are fewer and fewer workers providing pension payments for a larger group of retirees. You know, you look out long enough and that system becomes unsustainable. And there's a big political debate in Germany about what to do about this right now. But a lot of Germans are taking matters into their own hands and saying, look, I need to set some more money aside, and it's not going to be enough if I just put it in a bank account. So I'm going to start investing in the stock market.
So what does this mean then for the market and for the broader German economy that more people are willing to make this change?
Well, you know, it's an important thing. I mean, there's been this long running trend in Europe of people generally take less risk and invest less than in the U.S. And that shows up in all sorts of ways. It's relatively difficult to finance a startup in Europe and in a country like Germany. So if you have more people putting money into risky assets, that just has an effect, a ripple effect through the economy. It becomes easier to raise money. It becomes easier to build that hot new startup or, finance a young growing company. And, you know, Germany, big, powerful economy, but it is not a dynamic economy. It's barely grown or has been shrinking for the past several years. And so if you get more financing and more risk taking, that should be good for the economy.
How big is the retail trading market in Germany now? I suppose, and how does it compare to other countries? And is this a market that there's more room for expansion?
There's absolutely more room for expansion. Institutional investors have long been a big player in Germany, but individuals, it's a tiny fraction. In the U.S., I think, like something like 42% of financial assets are in stocks. In Germany, that's around 20%. So you see, if Germans were to put say an equivalent of the U.S. or even France of their assets into the stock market, that makes a huge effect. We saw one estimate from a think tank funded by the finance industry that says there'd be an extra 1.1 trillion available for equity financing if Germans invested even to the level that the French do. So that makes a big difference. The German stock market is about 2.6 trillion in market value right now. So that would really move the needle if Germans, as a whole, invested a lot more in the stock market.
So where are these investors putting their money there? What stocks are they buying?
Yeah, that's one thing that's a bit of a problem right now. The U.S. stock market has such a magnetic pull on the rest of the world that, we talked to eToro, the online broker, and they said of the 10 most owned stocks in German accounts this year, 9 of them are American, and they're the ones you'd expect, Tesla and Microsoft and the big tech stocks. There is exactly one German stock among the top 10, and that's Rheinmetall, the big defense contractor. But you can sense, at least anecdotally from the people we've spoken to, that's starting to change. They're looking at these stocks, like the German defense stocks have been on fire this year. They're putting up returns like the tech stocks, 100%, 200%. And Germans are saying, hey, look at that. I would like to get some of that. And so there is starting to be a shift. The question is, does that hold up if there's a bear market? Do people just walk away and not come back for a decade or whatever? But for now, at least, they're embracing it, and they're starting to buy more German stocks.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.